Hello everyone, welcome to Moneycontrol's Ideas for Profit. The company that we'll be talking about today is Polycab India. Well, the company is a manufacturer of wires and cables and is a leading manufacturer in the industry. Well, the company is coming up with an IPO of 1350 crores and the total market cap of the company is pegged at around 8,000 crores post the issue. Well, let's look about the business, what the company does and what the company is into. Well, the company operates in three major segments. The first is the wires and cable segment, which contributes around 90% of the revenues of the company. In this segment, the company manufactures a whole host of products. The wires and cables that we use in our household for electrical purposes, from that to the power transmission grid line, the whole host of products are manufactured by Polycab India. The other segment that the company is into EPC division, through which it provides electrical turnkey solutions to its clients. This segment contributes around 3 to 4% of the revenues of the company. The third segment that the company caters to is the FMEG segment, the fast moving electrical goods segment. The product suite in this segment includes fans, pumps, lightings and switchgears. So overall, the company is into basically three segments. So let's talk about what are key aspects of the business. Well, the company is a leader in the wires and cables industry. The market size of the wires and cable industry in India is pegged at around 52,000 crores. The company generated around 6,000 crores of revenues in FY18, which translates to a market share of around 12%. Companies such as Havells, KEI, Finolex have a market share around 5 to 6%, which means that Polycab as a company is twice the size of its nearest competitor. So the company has a dominant position in the market. The second aspect which this works in favor of the company is its strong financial track record. The company has been a strong, consistent performer in terms of financial and has been clocking revenue growth around 10 to 12% consistently over the last 4 to 5 fiscal years. The EBITDA margins have been also on an uptrend and have scaled up its EBITDA margins from around 8 to 9% a couple of years back to around 12% currently. So the operating profit growth has been much faster than in terms of the top line. The third aspect which the company is focusing on is the FMEG segment. This segment of the company has a strong retail presence and caters to products such as fans, lighting, switchgears. So the scale up of this business is actually a revenue driver from the retail side perspective. The fourth factor which works in favor of the company is its in-house manufacturing capacities. The company controls the sourcing as well as design as well as manufacturing of all its equipments and things that it manufactures. So that gives the company a greater control in terms of the entire value chain and allows it to control costs as well. So despite being an asset heavy business model, the company generates return ratios of around 20%. In FY18, they did a return ratio of around 20% and also in 9 months FY19, the return ratios have been in line with the previous years. So that really bodes well in terms of the company's financial performance. So what are the key risks to the business? Well, the company is a manufacturer of wires and cables primarily. Copper as well as aluminum are the two important raw materials, and the company imports these raw materials from outside. So volatility in commodity prices as well as adverse currency fluctuations can have a bearing on the margins of the company. However, the company has been trying to mitigate this risk by entering into a JV with Trafigura to set up a copper manufacturing facility which takes care of the in-house copper requirements. So that really bodes well for the company in terms of negating this risk. However, the volatility in commodity prices cannot be ruled out from this perspective. The second factor which needs a close watch is the FMEG business. The company has been scaling up this business very rapidly. It started in 2014. In FY18, it did revenues of around 500 crores. The operating margins are still lower at 3.3%. So for the scale up of business is really challenging as the business is fairly competitive with a large number of competitive players in the market, both from the domestic front as well as from the international front. So the company needs to keep on incurring higher expenses in terms of advertising, selling, distribution to be able to further scale up this business from current levels. Well, the company has a strong footing in the market. In terms of valuation, it's trading at around 16 times FY20 earnings, which is at a minor discount to the listed peers, KEI as well as Finolex. Well, the issue price offers enough on the table for the long-term investors. Therefore, one can look forward to subscribe to this issue. That's it about the Polycab India IPO review. For more views and updates, do log on to moneycontrol.com.